Jesse Livermore made a fortune, then lost most of it by making one mistake, spreading himself across too many positions. He wrote,
"It is dangerous to start spreading out all over the market. It is much easier to watch a few than many. I made that mistake years ago, and it cost me money."
If you can't make money on ES and NQ, the most liquid futures contracts, adding crude oil, gold, and Bitcoin won't fix your problem. It'll just give you more losing positions. Here's what Livermore learned about focus. Livermore's rule was simple.
Confine your studies of movements to the prominent stocks of the day. If you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole.
In futures terms, if you're tracking 6 different contracts, you can't see the character of any single one. You can't spot the danger signals. You can't read the volume patterns. You're reacting to alerts instead of observing trends. Livermore said,
Definitely, it is not safe to try to keep account of too many stocks at one time. You will become entangled and confused.
Entangled and confused. That's what happens when you have 6 charts open, all flashing signals, all demanding decisions. His solution:
try to analyze comparatively few groups. You will find it is much easier to obtain a true picture that way than if you tried to dissect the whole market.
Focus on the leaders. Ignore everything else. This is Chapter 3 of our breakdown of Jesse Livermore's book, How to Trade in Stocks. Everything comes directly from his writing, his own words, his own mistakes, his own solutions applied to modern futures trading. Chapter 1 was about patience. Chapter 2 was about recognizing danger signals. Chapter 3 is about focus and how spreading yourself too thin destroys your ability to read any market correctly. Livermore described exactly how this pattern destroys accounts.
Another mistake I made was to permit myself to turn completely bearish or bullish on the whole market because one stock in some particular group had plainly reversed its course from the general market trend.
He saw one sector top out and assumed everything was topping. So he exited everything and started shorting everything. Here's his example.
Back in the wild bull markets of the late 20s, I saw clearly that the advance in the copper stocks had come to an end. A short time later, the advance in the motor group reached its zenith. Because the bull market in those two groups had terminated, I soon arrived at the faulty conclusion that I could safely sell everything.
He was right about copper, right about motors, but wrong about the overall market. The result:
while I was piling up huge paper profits on my copper and motor deals, I lost even more in the next 6 months, trying to find the top of the utility group.
Utilities kept running. He kept shorting. He gave back more than he made. In futures, ES tops out. You exit, that's correct. But don't assume NQ is topping just because ES did. Wait for NQ to show its own danger signal before acting. Don't spread your thesis across the entire market just because one position worked. Livermore tracked market leaders obsessively. Not every stock, just the leaders. He wrote,
just as styles in women's gowns and hats and costume jewelry are forever changing with time, the old leaders of the stock market are dropped and new ones rise up to take their places.
Leaders evolve. In his time, railroads, then steels, then motors, then aircraft. He said,
today we have only 4 groups in the position of dominating the market: steels, motors, aircraft stocks, and mail orders. As they go, so goes the whole market.
4 groups, not 40. 4. Livermore was trading individual stocks before index futures like ES and NQ existed. But the principle applies. Identify what's leading the market and focus there. For futures traders today, The leaders are ES, NQ, and maybe GC. That's it. The indices themselves stay consistent, but what drives them evolves as the underlying stocks change. Your job isn't to trade everything. It's to identify what's leading right now and focus there. Livermore continued.
If you analyze correctly the course of 2 stocks in the 4 prominent groups, you need not worry about what the rest are going to do. It becomes the old story of follow the leader.
2 instruments per sector, not 20. 2. If you can't make money on ES and NQ, adding positions in crude, gold, bonds, and Bitcoin won't help. You'll just have more charts you can't read properly. Livermore had a theory about why markets move.
We know that prices move up and down. They always have and they always will. My theory is that behind these major movements is an irresistible force that is all one needs to know.
An irresistible force. He didn't care why. He didn't need the narrative.
It is not well to be too curious about all the reasons behind price movements. You risk the danger of clouding your mind with non-essentials. Just recognize that the movement is there and take advantage of it by steering your speculative ship along with the tide.
Stop looking for reasons. Stop trying to explain every move with Fed policy or earnings or geopolitics. The movement is there. Trade it or don't. But don't cloud your judgment trying to understand why. His warning.
Do not argue with the condition, and most of all, do not try to combat it.
NQ is trending higher. You don't need to know why. You don't need to agree with it. You just follow it or step aside. Fighting the trend because you think it's wrong is how you blow up. Livermore talked about adapting to market conditions.
Under conditions as they currently exist, I do not believe that a speculator of the old type who traded in huge volume has much chance of success.
Markets had changed. Less liquidity than the 1920s. Harder to build massive positions without moving price. His adaptation.
The speculator of today, who has the patience and judgment to wait the proper time for acting, has, in my opinion, a better chance of cashing in good profits eventually, because the current market does not lend itself to so many artificial movements.
Fewer fake-outs. Cleaner trends if you wait for them. His conclusion.
No speculator who is intelligent will permit himself to operate on that scale, which was more or less a commonplace some years ago. He will study a limited number of groups and of leaders in those groups. He will learn to look before he leaps.
Smaller watch list. Better focus. Higher probability setups. For futures traders, whether you're trading prop evaluations or your own capital, focus beats diversification. Get comfortable with ES and NQ before adding commodities or crypto. Spreading attention across 6 instruments means you can't read any of them properly. The principle: focus on the most liquid instruments during the most liquid hours. Don't spread yourself into markets where you can't execute cleanly. Livermore shared how he started.
When I first became interested in the movement of prices long ago, I decided to test my ability to anticipate correctly forthcoming movements. I recorded fictitious trades in a little book which was always with me.
Paper trading, tracking patterns, building a system before risking real money.
In the course of time, I made my first actual trade. I never will forget that trade. I had half interest in a purchase of 5 shares of Chicago, Burlington, and Quincy Railway stock, bought with a friend of mine, and my share of the profit amounted to $3.12.
$3.12. That was his start. A tiny winner that confirmed his system worked.
From that time on, I became a speculator on my own.
The lesson: if you're not tracking patterns before trading real money, you're gambling. He said,
Today, in my records, I keep 4 individual groups. That does not mean I am trading in all of the groups at the same time, but I have a genuine purpose in mind.
He tracked 4 groups, but didn't trade all 4. He waited for the leaders to show him which one was ready. Whether you're testing on a prop firm evaluation or trading your own account, do you actually know which setups work? Or are you just hoping? Livermore ended with this.
Keep mentally flexible. Remember, the leaders of today may not be the leaders 2 years from now.
The market evolves. What worked last year might not work this year. Market conditions change even if the instruments stay the same. Your job is to adapt, not cling to old patterns because they used to work. He wrote,
It is obvious, therefore, that in light of conditions which exist today, no speculator who is intelligent will permit himself to operate on that scale, which was more or less a commonplace some years ago.
Markets change. Liquidity changes. Volatility changes. Your approach has to change with it. But the principles don't change. Focus on leaders. Wait for confirmation in each instrument. Don't spread yourself across too many positions, and never argue with the trend. That's Chapter 3. If you can't make money on the most active, most liquid instruments, you won't make money adding more tickers to your watch list. Focus, follow the leaders, and wait for each one to show you it's ready before you act. Livermore kept 4 groups in his records, but didn't trade all of them at once. He waited for the leaders to signal when to act. If you're serious about following the leaders instead of spreading yourself thin across every ticker that moves, check the links below. Platforms for charting, backtesting, journaling, automated analytics, psychology tools, TradeSync, and prop firm funding. If this helped, hit like and subscribe for Chapter 4. We'll cover Livermore's money management rules, how to size positions and protect capital once you're in a winning trade. Order filled, helping you see the game clearly so you don't get played. Educational only, not financial advice. Futures trading carries risk. Protect your capital.